Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, independent financial advisor and owner of Elevation Financial. I am glad you are here today. Thanks for joining me as always. We are talking cryptocurrency today, Bitcoin, digital assets, cryptocurrency, all somewhat interchangeable-ish. We're going to talk about that today. And specifically, should I invest in digital assets like Bitcoin? I don't know. Let's talk about it. The answer, I'm going to go ahead and give you a spoiler alert right now. I'm not going to tell you whether you should or not. The answer is going to be maybe. So I want to go ahead and give you that spoiler alert up front so that I set expectations properly. I cannot give specific advice on a podcast like this because I don't know who's listening. So I want to go ahead and give you the caveat that this is not specific investment advice. This is not a recommendation to buy Bitcoin or any other cryptocurrency or any specific recommendation at all. This is an educational walkthrough to try to help you be more informed so you can make a good decision either on your own or with your investment professional. So again, not specific advice, being very clear about that. So let's dive in. Should I invest in digital assets, also called cryptocurrency, like Bitcoin? So first, let's talk terminology. What are digital assets? So I talk about cryptocurrency in the term digital assets. This is sort of a more accepted or modern term, mainly used by financial professionals, financial advisors, because it more correctly labels the asset as in terms of what it's really used for. It's called cryptocurrency by most. I would say many people still call it cryptocurrency, and that's accurate as well. But cryptocurrency implies that assets like Bitcoin or Ethereum or Dogecoin or other crypto assets out there are used for currency or will be eventually used for currency. So there's still controversy about this. There's differing opinions, but most financial professionals that I have seen or been in contact with or been learning from are pretty much of the mind that Bitcoin, for example, is not going to replace the US dollar or any dollar. Digital assets are not necessarily, while originally they were meant to be set up as an alternative to buy goods and services, similar to money we have now, they're really not on a path to take the place of currency that we use today. So they're more thought of as an asset class. An asset class is things like equities, fixed income, which are stocks and bonds, commodities, gold, things like that. So an asset class is a category of assets, things that have value. So Bitcoin and other cryptocurrencies, they are digital assets. And also when I say Bitcoin, I'm going to sometimes use that interchangeably as a stand-in for cryptocurrency in general, but sometimes it will be related directly to Bitcoin. Bitcoin is the most well-known, kind of the leader, the most popular. So a lot of this can be applied to Bitcoin and sometimes can also be applied to other cryptocurrencies or other digital assets. So keep that in mind. I may use Bitcoin or digital assets interchangeably. Sometimes it means Bitcoin. Sometimes it means Bitcoin and other stuff like Bitcoin. So just keep that in mind. So unlike traditional currency, which is minted, produced by a government, there's no physical crypto coins. They only exist in digital form. So there's no physical assets. They are all digital assets. It's built on what's called the blockchain technology. We'll kind of start with a quick background for those who may be less familiar with digital assets. It's built on what's called the blockchain, which is a decentralized open ledger of recorded balances and transactions. So really, it's just code. Digital assets like Bitcoin are really just lines of code. Really, that's really where it exists. Again, Bitcoin is the most well-known version. There are over 5,000 different types of cryptos, like Ethereum, like Litecoin, other types. The other types of coins that are not Bitcoin are sometimes referred to as altcoins. So Bitcoin is kind of the main one, and everything else is referred to as altcoins. So that's kind of a terminology you might be familiar with. So currency that's issued by the U.S. government is called fiat currency, and it's backed by the full faith and credit of the government. And so it's kind of saying, hey, the government is backing this currency. We're putting our full faith and credit behind it. That gives it stability and value and reassurance. And decades ago, it used to be backed by gold, but that's no longer the case anymore. So just like the cash in your pocket is nothing more than paper, gold is just a shiny rock. These things hold value because our society believes they do. So we know that if we go buy something or attempt to buy something, we can use paper money, or we could in theory use gold if someone sees gold as valuable, which they typically do. So these things we have that we can hold in our hands have value because our society collectively agrees that they have value. So therefore they're worth something. And that's kind of what also gives digital assets value as well, the market demand and the belief that the assets have value. So inherently, I think we all agree that Bitcoin has no value inherently. It's just this electronic thing that exists in the digital world. But enough people in our society have agreed that it has value and created demand for it, which is what gives Bitcoin and other crypto assets value. That's kind of simply put. So where do they come from? Where do these digital assets come from? So at a high level, they come from miners who are a worldwide network of computers. They voluntarily work to validate these Bitcoin transactions. Other cryptos work in a similar fashion. They do this by adding new groups of transactions called blocks onto the existing blockchain. And that is what adds to the blockchain and adds more records to the blockchain. So there is a whole bunch of these miners. There's hundreds of them, thousands of miners that, they work to validate new blocks at any given time. And to validate these blocks, they have to solve a complex mathematical problem. They use, this uses a lot of computing power and a lot of energy. And we'll get to the energy part a little bit later here in a few minutes, but this does use a lot of computing power and a lot of energy to run these transactions. So as the miners add new transactions, they're also checking the inputs of the ledger to ensure the transaction has not taken place before. So they're the first ones to create that new block. And because the ledger is open source and visible to everybody, it's basically impossible to change a previous block because everyone could see what's happening. So the transparency is kind of what gives it security as well. So in addition to validating the transactions, the miners also introduced new cryptocurrencies into circulation. And as a for Bitcoin, specifically, for example, for Bitcoin, every new block that's added, every new currency that's added, or every new coin, so to speak, that's added, they're given 6.25 Bitcoin. So every block that's added, I should say, they're given 6.25 Bitcoins as of right now. The number is cut in half every 4 years, specifically to Bitcoin, to help preserve the crypto's scarcity. And speaking of scarcity, Bitcoin has scarcity. Bitcoin has a maximum of 21 million Bitcoins available. So there's an upper limit. There's a limit you can reach. So some digital assets have limited supply and some don't. So some of the examples of assets with limited supply include Bitcoin, Chainlink, Litecoin. You may have heard of some of those. Others have unlimited supply, things like Ethereum, which you may have heard of, which is the second most popular. Dogecoin has unlimited supply. So some have limited, some have unlimited. The pros and cons are kind of beyond the scope of today's discussion to keep it on the shorter side. So just be aware that some have limited supply. So let's talk about how digital assets behave. Digital assets behave in a low correlation with other asset classes. What does that mean? That means that sometimes we can look at asset classes and we can see that they behave in a correlated fashion. Sometimes if you have, asset class A, asset class B, if asset class A goes up in value, you'll see asset class B go up in value, or maybe they're inversely related. They're inversely correlated. So certain asset classes tend to increase or decrease in value at similar rates, which means they're correlated, or they're inversely correlated, which means they go in opposite directions. So what's interesting is Bitcoin and other assets like Bitcoin have a very low correlation with other asset classes. They don't follow any specific pattern when it comes to how other asset classes behave. So, when stocks go up, Bitcoin might go up, but it might go down. There's not a clear correlation there. When bonds or gold goes up and down, Bitcoin may or may not go up and down. It's not necessarily directly correlated. It's really driven by market sentiment. The market sentiment and the market demand is primarily what's driving Bitcoin and other digital assets. So let's look at some returns. How do they behave? So let's take some snapshots here. So first of all, the big dramatic number everyone loves to point to and say, wow, Bitcoin is incredible, is from Bitcoin's inception to the end of 2020, Bitcoin's return, total cumulative return, has been 41 million%. So that's massive, right? That's dramatic. That's a big number we can, kind of wrap our head around and say, wow, that's incredible. Some other years, let's look at Bitcoin's return in 2020. 2020's return for Bitcoin was 301%. Also, again, massive. However, Bitcoin's return in 2018, negative 73%. Pretty major drop, pretty significant negative return there. So Bitcoin has seen really massive volatile ups and downs. It's very volatile, very high risk as a result. Again, very low or zero correlation with other asset classes. So, in 2017 alone, looking at some more snapshots, Bitcoin rose 1,300%. In 2019, it fell 74%. So we've seen some really big swings in Bitcoin and other similar digital assets. So let's talk about the investment thesis for digital assets. Investment thesis kind of means like what's the case for considering an investment in Bitcoin or digital assets that might be similar. So I want to be really clear. I'm not saying you should invest in Bitcoin or other assets. I'm not making any specific recommendation. But if you're thinking through, is there a case to be made to consider it as an option? Here are some things to think through. First of all, Bitcoin is uncorrelated to other asset classes, which we talked about. This is something we kind of want in general in a portfolio. We don't want all of our asset classes to work the same way. That kind of defeats the purpose of diversification. So, most investors and most financial advisors like me will recommend a diversified portfolio with a mixture of different types of asset classes. So you have different correlations. They all don't move the same way. They have some diversity between them. So Bitcoin does kind of check that box. Bitcoin is fairly uncorrelated to other asset classes. Also, the historic returns have been unprecedented. It's been incredible. So there is a case to be made that, wow, if you look at the history of Bitcoin and other asset classes or other digital assets, and we kind of apply that same methodology to other assets like stocks or bonds, most people would say, wow, this return has been phenomenal. That may point to, potential interest in investing. Although I want to be careful to say that past performance is not indicative of future returns. That's a phrase you'll hear a lot when talking to people like me. We cannot predict the future. We cannot, with any certainty at all, say that because an asset has performed well in the past, that it will continue to perform well. That is not the case. We don't have a crystal ball. So keep that in mind. So here's another fun fact about Bitcoin. Bitcoin halvings are scheduled to occur every 210,000 blocks, which is roughly every 4 years, until the maximum supply of 21 million Bitcoins have been released into the Bitcoin network. So on the day of halvings, the number of Bitcoin rewards given to Bitcoin miners for processing transactions is cut by 50%. So these Bitcoin halvings have been correlated with massive surges in Bitcoin's price. Every time we've had a halving, we've had a massive surge in Bitcoin's price. This pattern has so far been true. Again, keeping in mind that past performance does not equal predicting the future, but this is what's been happening. The first halving occurred November 2012. That sent Bitcoin from $12 to nearly over $1,000 within a year. The second halving was July of 2016. The price went from $650 to $20,000 in the next 17 months. The third and most recent halving occurred in May of 2020, which was a catalyst to the recent surge of just under $50,000. So the next halving is expected to happen in 2024. So you can look at that pattern and make your own conclusions, but that's what's been happening as a recent pattern. So let's look at some examples of how Bitcoin can behave in an overall portfolio. So one of the things I like to talk to people about is that you don't have to make these massive bets on Bitcoin to get some benefit. A lot of people, they just, they plunk a bunch of money into it. They treat it like, day trading. They treat it like gambling. And I don't recommend that necessarily. You don't have to necessarily treat Bitcoin like gambling or like day trading to receive some benefit from it, or some potential benefit, I should be careful to say. So here's an example of how Bitcoin can behave in a portfolio. Let's take a 60-40 portfolio. That means 60% stocks, 40% bonds. Stocks are slices of ownership in a company. Bonds are slices of debt that you lend to a company. So basically, stocks and bonds, typically they're meant to either produce growth or stabilize a portfolio with more limited growth. That's the general mix we see in a lot of portfolios: is how many stocks, how many bonds, or how much of it is stocks, how much of it is bonds. So 60-40 is 60% stocks, or stock funds, I should say, mutual funds, and 40% bond funds. So scenario one, let's look at a snapshot and see how it compares. Let's say in scenario one, in the first year, the 60-40 portfolio makes 7%. That's fairly rational. That could happen, not out of the ordinary. In year two, the total return across those 2 years is, let's say it's 14.5%. That's how this given portfolio is behaving. Okay, that's year 1 through 2, total return 14.5%, basic vanilla 60-40 portfolio. In scenario 2, let's add 1% Bitcoin to it. So in scenario 2, we have a 59-41 portfolio, 59% stock funds, 40% bonds, 1% Bitcoin. So in the first year, let's say in scenario 2, we see waves and crashes like we see in the past in Bitcoin. We see the big waves, the huge returns, and then the crash that comes later, these massive swings. So in year 1, we see that we get a wave. So in that scenario, the portfolio is now up 22% in year 1. In year 2, with that same portfolio, but adding Bitcoin in as a slice, it crashes in year 2. We have this big swing and big crash. The total return across those 2 years ends up being 15.4%. Still better off than we were in scenario 1. This is, again, using historical numbers. Okay, so we've seen that in this scenario, 1% Bitcoin can produce some pretty decent upside. And based on historical scenarios that have already occurred, the downside is actually not bad. You actually still end up better off. Let's look at a third scenario. The third scenario is that Bitcoin was completely wiped out. Let's say that with the same portfolio of 59-41, so 59% mutual or stock funds, 40% bond funds, 1% Bitcoin. Let's say Bitcoin goes to 0. In year 1, 6%. Year 2, total return across 2 years, 13.4%. So the question I would ask is, was harm caused by adding 1% allocation to Bitcoin? I mean, I'll let you decide, but the numbers are fairly self-explanatory. So adding 1% Bitcoin allocation has generally been found overall to increase what's called the Sharpe ratio of a portfolio, which is the risk-adjusted return. We want a higher Sharpe ratio. This is what we want. It's typically, generally a good thing to have a higher Sharpe ratio. That kind of tells you that your trade-off of risk versus return is getting more favorable. So in most scenarios, again, adding that 1% slice of Bitcoin allocation increases your risk-adjusted return, which is a good thing. And it doesn't necessarily cause massive harm, even if it goes completely to 0. So again, the numbers pretty much speak for themselves. So I would ask you again, was harm caused by adding 1% Bitcoin? I think it's fairly easy to determine what your answer would be. So if you have a desire to invest in Bitcoin or other digital assets that are similar, the allocation doesn't need to be large to get benefit from it, and it likely should not be. So keep that in mind. All right, let's talk about the environment. As many know, I focus on socially conscious and ESG investing, which is a whole different topic, but part of that is caring about the environment and attempting to make a positive impact on the environment with our investing and financial practices, as well as avoiding negative impact. So this is important to me. It's important to a lot of people that I work with. So let's talk about it. So there's a popular belief that Bitcoin and other digital assets are bad for the environment. It's kind of it's been going around as a trend. It's been headlines. People are of the belief that Bitcoin is bad for the environment. And one, here's some numbers to make that case. Scientists from the University of Cambridge, Judge Business School have built an interactive analysis tool in which they calculated the real energy cost of Bitcoin cryptocurrency. And using their energy use model, they found that Bitcoin mining uses more energy each year than the entire country of Argentina. That sounds massive, right? That sounds very dramatic. But let's put it in context. Argentina doesn't use that much energy. Argentina ranks last on the list of the 30 biggest industrialized countries in the world. Okay, so in perspective, Argentina does not actually use that much energy comparatively. And we'll come back to that in a minute, but also Bitcoin is one of many things that are bad for the planet. Driving cars is bad for the planet. All the devices we use are bad for the planet. For example, the proponents of Bitcoin rightly point out that mining is increasingly being done with electricity from renewable energy sources. because that type of energy saves them money, honestly. As it becomes cheaper, the energy used is far lower than other more wasteful uses of power. Again, like those devices. The energy wasted by plugging or plugged in but inactive home devices in the US alone could power Bitcoin mining for the next 1.8 years, according to the Cambridge Bitcoin Electricity Consumption Index. So another way to say this is in the US alone, those devices consume almost twice as much energy as all the Bitcoin miners in the entire world. So all those TVs that stay plugged in, the Alexa devices, all those devices that we leave plugged in all day long and all night in our homes actually use twice as much energy as all the Bitcoin mining happening in the entire world right now. So I'm not saying Bitcoin is great for the planet, but I'm saying that there's more to the story here. And some have pointed out that there doesn't have to be a trade-off between crypto and the environment. The creators of Ethereum, for example, consider which is the second most popular form of digital asset after Bitcoin. They've promised to change the currency's algorithm to make mining more environmentally friendly. So there's already work being done on many assets to improve the environmental footprint, or rather decrease the footprint and improve the efficiency. Also, Bitcoin miners and other miners are incentivized to seek out clean energy because of the cost. And there are digital assets that use far less energy than Bitcoin. There's SolarCoin, there's BitGreen, there's Stellar, there's EOS. There's a lot of coins out there that are specifically designed to be efficient, energy efficient, and low energy usage. And some people would argue that other digital assets, the Bitcoin and other digital assets, will end up doing more good than harm to the planet because there's a clear and direct incentive to lower your energy costs. So other industries like automotive, for example, have a massive challenge when it comes to lowering energy consumption because of the complexity of the manufacturing process, the supply chain. It's just a large kind of beast to turn around. But crypto mining is pretty cut and dry. It's all digital. And the lower the energy cost, the higher the profit for crypto miners. Therefore, that tends to drive innovation in clean and renewable energy. And in fact, the Cambridge Center for Alternative Finance found that 76% of Bitcoin miners are already using renewable energy, such as water, solar, and wind. And this trend is continuing. So keep in mind that, and by the way, one more thing I want to add is, Bitcoin is one of those limited supply cryptocurrencies. At some point, we're going to reach that limit. And when that happens, the mining is not going to be using energy anymore. So we're going to reach a point where the energy consumption has a finite end to it as well. So all this to say, the point is not that digital assets are definitively good or bad for the environment, but that it's a more complex and nuanced discussion than the headlines make it out to be. So yes, we want to be friendly to the earth. We want to be good stewards. We want to be socially conscious and not make a negative impact on the environment. But again, the discussion is much more complex and nuanced than just Bitcoin is bad for the earth. That's not a fair statement to just kind of hang your head on necessarily. So kind of think through all those factors. So should you invest in digital assets? I told you the spoiler alert was that the answer was going to be maybe. And my answer is still maybe. Obviously, I can't tell you whether you should invest in digital assets or not. If you're my client, I could tell you in a direct meeting, and I have done that with meetings. So if you're working through directly, let's talk about it. If you're not my client, talk to a professional as well if you want some more advice or kind of do your own research. But you want to consider your goals. Are you interested in taking on more risk in exchange for potentially greater returns? If you're interested in that and you're able to take on more risk and your financial plan has space for it, then it may or may not make sense for you. It's not about, do I want to get in on this gold rush or, give into my FOMO? It's more, does your plan have space for this kind of risk and reward scenario? And again, are you interested in taking on that risk in exchange for that potentially greater return? Are you able to do that? Do the facts of your financial life line up in such a way that allows you to withstand that risk? Does your financial plan have the space for it? Or are you already on track and maybe you don't need to make any changes? That's also valid. You can certainly say, you know what, I'm on track. I'm very happy with the way my financial plan is set up. My investments are performing the way I want them to, or they're set up with expectations that match my financial plan. I'm good. I don't feel FOMO. I don't feel like I have to get in this whole trend. I'm just going to not do any digital assets. I'm not going to do Bitcoin, crypto. That's fine. You don't have to. So what's right for one person is not right for someone else. So keep in mind that you want to think through carefully what your goals are, what the facts are of your financial life, and that's more important in answering the question of should I invest in digital assets. So let's say you decide to, how do you invest? That's a little bit beyond the scope, but we're going to just kind of touch on a few things. You can invest directly through an exchange like Coinbase or Gemini. Those are pretty popular custodians. They are some of the leading custodians to hold your crypto and your digital assets. You can do it through an over-the-counter ETF. This is a mutual fund that is indirectly kind of tracks the price of digital assets. So things like the Grayscale Bitcoin Trust, the Osprey Bitcoin Trust. There's a Bitwise ETF that tracks the top 10 digital assets. They don't necessarily give you direct access, but they are a way to loosely track the price of digital assets, which is kind of the best thing we have today besides direct investment. So eventually, my belief, again, this is not a prediction, but my belief is that we will have a Bitcoin ETF hopefully soon. I'm just going to say soonish because no one really knows. It's under review with the SEC. It's been kind of put off a couple times already, but there's a lot of pressure to create a Bitcoin ETF that directly invests in Bitcoin and gives you direct exposure to the value of Bitcoin at any given time. And following Bitcoin, we should see, I'm predicting, again, just guesstimating, that we'll see Ethereum and other digital assets follow suit after the Bitcoin ETF is released. It may never happen. I'm going to be very clear. It may never happen. But my belief is that there is a decent chance it will happen fairly soon-ish, which will make it a lot easier to invest in Bitcoin and other digital assets directly in your portfolio. So that is my discussion today about Bitcoin and other digital assets. So again, this is not a recommendation. This is not a specific suggestion at all. This is background information that I'm hoping will give you tools to think through if it makes sense for you and to understand and kind of cut through the hype around digital assets and crypto and understanding what's really happening and what the facts are around this asset. So I hope that's been helpful. I know that there's a lot to uncover still, a lot of research you can do. Again, I talk to my clients about this as well. It's a topic that's come up a lot recently. If you would like to talk more about this in a one-on-one setting and maybe talk about, what questions I can answer for you, as always, go to my website, elevationfinancial.com. Just reach out there or book a meeting, and I'm happy to chat. So with that, I will go ahead and wrap things up. So thanks everyone for joining us today. Joining me today, I guess I should say. No one else is here. I appreciate you being a listener as always. If you like this podcast, I'd love it if you'd share it with a friend or leave me a review or both. That would be cool. So thanks everyone for joining me today. Have a great day. We'll see you next time.